Let's work through a few problems from the current liabilities and payroll accounting chapter. This first exercise is going to have us classify liabilities as to whether they are current or long-term or even possibly not a liability at all. Remember, by definition, liabilities are amounts that the company owes to others. Notes payable are liabilities that the company has signed a promissory note stating they will pay back the amount owed plus interest. If it is not an amount owed, it's not going to be a liability. Right? Current versus long term. Any amount that has to be paid within the next 12 months is considered current. Any amount that does not have to be paid within the next 12 months is considered long term. So if we have a note payable that is due anywhere between 13 to 24 months, it's going to be a long-term liability. It is not current. But a note payable that is due sometime between the next 6 to 11 months, that is going to be a current liability. Notes payable that mature in 5 years. If they mature in 5 years, it means they're not going to be paid for another 5 years. It would be long-term. Paid within 1 year or 12 months, current. Paid beyond the next year, non-current or long-term. If we have a long-term liability that has a current portion of it due within the next 12 months, right? If you have, let's say, a mortgage payable, and the mortgage payable in full, in total, is not due for 30 years, but there's monthly payments. That means you're going to be making some payments on that liability over the next 12 months. Well, the current portion, or the portion of that debt that will be paid in the next 12 months, that would be reported as current. And the remainder of that long-term debt, the amount that won't be paid within the next year, that would be reported separately in the long-term liability section. Okay. Any notes payable that are due within 120 days, that's within the next 12 months, it is going to be a current liability. Federal unemployment taxes, amounts that the company owes for their unemployment taxes, guarantee you the government's not going to wait for more than a month or two to get that payment from the company, so it would be current. Accounts receivable. That is an asset. That's not even a liability. Accounts receivable are amounts that are owed to the company from a customer that they sold to on credit. Sales taxes payable. Again, they collected sales tax from customers when customers paid for their purchases. That amount collected is owed to the local or state government. I guarantee you the local or state government isn't going to want to wait long to get that money from the company, so it's going to be payables very soon, and it's going to be current. Salaries payable. Employees aren't going to wait for another year to receive the amount that they have earned from working for the company, so we know it's going to be paid sometime very soon. It's current. Wages payable, exact same thing. Okay. All right, so hopefully this helps you with your classification of current versus long-term. We look a lot at what we call known liabilities, but there are also liabilities that are contingent, and that means they're contingent on something else occurring. For example, Hoopery Company is the defendant in the following legal claims. For each of these claims, we are to identify how Hoopery should report or record this liability. This legal claim means that it could be that the company is going to have a lawsuit brought against them. Okay? How we account for that or how we report it depends on a couple things. If we're reasonably assured, if we're reasonably possible that the liability will occur, that the lawsuit will be brought, and we can reasonably estimate the amount of the liability, then we would record it into the accounting system and report it within the balance sheet statement. Okay, so for example, if Hoopery can reasonably estimate that a pending lawsuit will result in damages of $1.25 million, it is probable that they will lose this case. So there's a case pending. That lawsuit exists, and the lawyers have told the company, listen, it's quite probable that you're going to lose this and you're going to have to pay. And the lawyers were able to estimate that the amount of the liability will be about 1.25 million. Because we can reasonably estimate the amount, and it is probable that the loss will occur, we are going to record a liability in the accounting system, and it will be reported in the balance sheet as a liability. But if it is only reasonably possible that Humphrey will lose this pending lawsuit, okay, it's not probable, but it's reasonably possible, we're still a really good chance. Unfortunately, the amount of the liability, the lawyers have no idea. It could be $1, it could be 5 million, they don't know. Because the loss cannot be estimated, we can't record it into the accounting system, but we still need to disclose it. So we put it into the footnotes that accompany the financial statement. It's possible that we're going to have this loss and have a liability, but because we cannot estimate it, we don't have a dollar amount reported in the balance sheet. And finally, if this company is being sued for damages of $2 million, and the lawyers have said it is so remote, it is very unlikely that you will lose and you will have to pay anything. We don't have to report it in the accounting system. We don't have to report it within the balance sheet. We don't have to disclose it. We don't have to do anything. No disclosure is required. Okay? The reason? Because it is very unlikely that we are going to have any type of loss. All right, that should hopefully get a little bit of clarification on the reporting of contingent liabilities. Another type of liability that a company needs to keep in mind or consider are liabilities that we know are going to happen, but we don't know exactly who we're going to be paying. We don't know maybe necessarily exactly how much, but we know that this liability will occur. Okay? So, for example, warranties are a great example of a known liability that we have to kind of estimate. So if Hitsu sold a copier that costs $4,800 for $6,000 cash with 2-year warranty parts to a customer on August 16th of the first year, they expect this warranty to cost 4% of the dollar sales. So based off of past experience, all of their copier sales, they estimate approximately 4% of their sales will result in warranty cost. What it's going to do is on December 31st of that year, when they made the sale, they're going to record an adjusting entry to record the warranty liability that was existence at the end of that year because they sold a copier that had a warranty. And they're going to be recording the expense so that they match the expense of that sale with the revenues that were earned. Okay. So on January 5th of the second year, the copier requires on-site repairs that were completed the same day. So the customer brought the copier in to get it repaired. The cost of the repair was for materials taken from the parts inventory. These were the only repairs that were required in year 2 for this copier. The first thing they want us to do is determine what the warranty expense will be for year 1. So in the year that the sale was earned, we need to record the warranty expense that went along with that sale, and the amount is going to be 4% of the dollar sales. So 4% of the dollar sales, $240 warranty expense in the year of sale. How much is the estimated warranty liability for this copier as of December 31st of year 1? Well, when we record this expense, we're going to be recording a $240 liability. So the balance on that liability at the end of year 1 is still going to be $240 because they haven't made any repairs. They haven't paid off that liability. How much will the warranty liability be at the end of the second year? Well, at the end of the second year, they will have paid off $209 worth of that liability. So the liability started year 2 at 240. Because we ended year 1 at 240, we started year 2 at 240. They paid off $209 worth of the liability, so the liability at the end of the year will be 31. So let's go ahead and prepare journal entries to see all of this happening. Okay, so let's start with the copier sale. Sold inventory for cash. The inventory had cost $4,800. So we would need to record the revenue earned, debit cash, credit our sales revenue, and then we would record the cost of the inventory that was used up and became an expense. So we will debit cost of goods sold, credit merchandise inventory. We learned how to record these entries back in an earlier chapter when we were looking at the sale of merchandise, recording retail sales. When we get to the end of the year that this sale was made, we also have to record that adjusting entry to record the warranty expense for that year, along with the liability. We calculated that the warranty expense in that year was $240. So we will debit the warranty expense at the end of that year and record a liability for that expense. It's still a liability because we haven't done any repairs for that copier the year it was sold. In the second year, when we make those repairs, we are going to essentially be paying off part of this liability. So the liability we recorded at the end of year 1 decreases when some of the repairs are made. And to pay off that liability, we pulled some parts out of our inventory. So our inventory for parts goes down. So we're decreasing our asset here. Okay, the big key in this exercise is to recognize this adjusting entry. The expense for the warranty was recorded in the same year, year 1, that the revenue was earned and recorded. Thus, we match the revenues with one of the expenses incurred to earn that sale. Right? The two expenses to earn that sale were cost of goods sold and warranty expense. And then we recorded a liability at the end of year 1 to essentially pay off that expense in the future. Okay, and it was just a very short time into the future when we actually paid off the liability by making the repairs. Right, one of the first exercises we did in these problems was to classify some liabilities, and we talked about notes payable. Now let's look at the accounting for notes payable. So this company, Terrell, entered into the following transactions involving short-term liabilities. On April 20th of the first year, they purchased merchandise on credit. Then a month later, they replaced that account payable with a note payable. In July, they borrowed some cash from a bank. We don't know the date that they paid the amount due on this locus note payable. We don't know the date that they paid the amount due on the bank note. November, they borrowed some more money, signing another note. December 31st, we're going to record an adjusting entry to accrue the interest on that note. And then in year 2, we don't know the date yet, but we're going to pay the amount due on that note when we borrowed money from the bank. Okay, so we have 3 different notes we're working with here. A note payable to Locus, a note payable to NBR Bank, and a note payable to Fargo Bank. The first thing we're going to do is determine the maturity date for each of these 3 notes that were described. The maturity date is determined based off of the date that the note is signed and its duration. So this Locus note, it was issued on May 19th. It is a 90-day note. So we need to determine when this thing will expire. Okay. So the easy way to do it is just to start thinking about how many days are in that current month. So in May, there are 31 days in May. So if I subtract 31 minus the date that the note was issued, 19, it tells me that 12 days on this note will pass during the month of May. It hasn't reached maturity yet because we need to get to the 90th day to reach maturity. So let's start counting the days in June. In June there are 30 days. So 12 days had passed in May. I'm going to add 30 days in June, which means by the end of June, 42 days have passed. Still haven't reached maturity. Haven't reached the 90th day. July, there are 31 days in July. So I'm going to add 31 to the days that passed in May, the days that passed in June, and the days that passed in July. We have now reached the 73rd day of that note. Still have not reached maturity, have not reached the 90th day. To reach maturity, we have to go another 17 days, which means we are going to go 17 days into the month of August. So the maturity date on this note will be August 17th. Do the same thing for the note to NBR Bank. The NBR Bank note was borrowed on July 8th. On July 8th, 31 days in July. So 31 days minus the day that it was issued, 23 days will pass on this note in July. It is a 120-day note, not even close to maturity. So let's start adding in the subsequent months. Try to figure out when this thing matures. August, there will be 31 days. So I'm going to add that to the days that passed in July. Gets us 54 days into the note. September, 30 days will pass. October, 31 days will pass. At this point, we are 115 days into the note. We only have to go 5 days into November to reach maturity. November 5th will be the maturity date. The note to Fargo, issued and signed on November 28th. It is a 60-day note. There are 30 days in November. I'm going to subtract the date it was issued, November 28th. 2 days on that note will pass during November. We haven't reached maturity of 60 days. December, 31 days will pass. That will get us 33 days into the note. Haven't reached maturity. We need to go another 27 days into January to reach maturity. So the due date, the maturity date, will be January 27th. All right, so now that we have the maturity dates on these notes, let's talk about how much interest the company is going to have to pay on each of these notes. And we're going to assume a 360-day year, okay? And that's what we call a banker's year. And what it does is it just spreads the interest evenly across all of the months. Okay? So when we're doing all our interest calculations, we will use a 360-day year. All right, so the locus note. $35,000 face value of the note, stated interest rate of 10%, 90-day note. If I multiply the face amount of the note times the stated interest rate, that would calculate the amount of interest for an entire year. This note is only in existence for 90 days. We are not going to pay a full year's worth of interest. We're only going to pay interest on those 90 days. So we will then multiply that annual interest by the fraction of the year. 90 divided by 360. We come up with the amount $875. That is the amount of interest that will be paid on this note when it reaches maturity date, along with the $35,000 owed. The NBR Bank. $42,000, excuse me, sorry, I missed the NBR Bank one. $80,000 note payable, 9% interest for 120 days. $80,000 times the stated interest rate of 9% times 0.09 times 120 divided by 360. Interest owed on that 120-day note, $2,400. Fargo Bank, $42,000 note payable, 8% interest for 60 days. 42,000 times 8% times 60 divided by 360. Let me see if I did my math right here. 42,000 times 8% times 60 divided by 360. Interest owed on that note, 560. Okay. But then this third requirement is asking us to determine the interest expense that is recorded in the adjusting entry at the end of year one. All right, let's think through what we would need to record an adjusting entry for at the end of year one. Because this note that we issued to Locust, it was issued on May 19th, and it's going to be paid off in August. So this note and the interest will all be recorded and paid off all within this calendar year. Same thing with the Fargo Bank. Note was signed on July 18th. It will mature on November 5th. Everything owed on this note will be paid all within this year. So there's no adjusting entry required. But this Fargo Bank note, this note is issued on November 28th. It is not going to mature until January 27th. We're not paid anything until January when we pay the note and the interest. But if we stop and think about this, of this $560 of interest that will be paid in January of next year, year two, some of that interest is an expense incurred in year one. So of this $560 total interest on that note, 33 days of that note are occurring in year one. 2 days in November, 31 days in December. 33 days out of the 60-day note is interest of year one. That means as of the end of the first year, we need to record an adjusting entry to record $308 of interest expense incurred in year one that hasn't been paid. Okay. That would mean the remaining 27 days on that note, the 27 days in January, that portion of the interest would be an interest expense in year two. Okay. So let's do the journal entries for all these transactions. We've done the hard part. We've done all the calculations. Now we're going to do the journal entries. So let's do the entry to record the purchase of merchandise on credit from Locust. Our company went out and bought inventory on credit. Didn't see anything about signing a note, so this is simply a purchase on account. So we will debit merchandise inventory, credit accounts payable. Then a month later, the terms had told us we had to pay in 30 days, but a month later we weren't ready to pay it, so we replaced that account payable to Locust with a 90-day 10% $35,000 note payable, along with paying part of that purchase in cash. So we went to the seller, Locust, and said, hey, we've got $5,250 in cash, but we don't have the remaining $35,000. So will you take a promissory note? And obviously the seller said yes, because we signed it. Okay, so that means on May 19th, the liability to accounts payable, that's gone. We've replaced that account payable by paying part of it off in cash. So we credit cash for the $5,250 and record a liability of notes payable. Okay, we now have a new liability, $35,000. July 8th, we borrowed $80,000 in cash from the bank by signing a 129% $80,000 note payable. July 8th, we get cash, increase cash of 80 with a debit, and credit the notes payable to the bank, 80,000. Finally, on this date, which we determined to be August 17th, the maturity date of the locust note, we paid the amount due at the maturity date. We owe $35,000 plus $875 in interest. So this liability of $35,000 that we recorded back on May 19th, on August 17th, it is being paid off. So we will decrease that liability with a debit. We will debit the interest expense to record the interest expense incurred of $875 and credit cash for $35,875. The next transaction is when we paid the amount due on the note to MBR Bank. So we are paying off this note. The amount of interest owed on that note on November 5th was $2,400. So when we pay off this note, we will decrease the notes payable $80,000, record our $2,400 of interest expense, and credit cash for the $82,400 that we're paying. November 28th, we borrowed $42,000 cash from Fargo Bank by signing this $42,000 note payable. Borrowed more cash on November 28th, debit cash to increase it, credit notes payable to increase it. December 31st, 33 days have passed since we signed that note, which means 33 days worth of interest have been accumulated or accrued. So on December 31st, we need to record 33 days worth of interest incurred but not paid. $308 worth. So we will debit the interest expense and record a liability with a credit, increase the interest payable. Finally, it is now the next year, and we paid the amount due on that Fargo Bank note on its maturity date of January 27th. Along with the interest, we have to pay the $42,000 owed. So the liability to the notes payable for the bank goes down with a debit. We are also going to pay off the liability for last year's interest, so that liability will decrease with a debit as well. We record the interest incurred for January 1st through January 27th of $252. So recording another $252 worth of interest incurred this year. Total cash paid $42,560. All right, our last problem in this chapter is looking at liabilities related to payroll. So on January 8th, the end of the first weekly pay period of the year, the company's employees had earned $22,760 of office salaries and $65,840 of sales salaries. These are the gross wages. These are the total amounts earned by the employees for their work during this pay period. Withholdings from the employees' salaries. These are amounts that the company withholds from what they actually pay to the employees. They withhold amounts from the employee pay for FICA, which includes Social Security and Medicare, 6.2% for FICA, Medicare at 1.45%. They are also withholding a total of $12,860 of federal income taxes, $1,340 for medical insurance deductions, so that's the employee's share of their medical premiums. And employees have also requested their employer withhold some money to pay their union dues, $840 worth. No employee has earned more than $7,000 in this first period, and that's important to know for purposes of calculating unemployment taxes. Okay, so we also need to pay attention to that this is the first pay period of the year, so none of the employees have reached any of the wage limits with respect to paying Social Security tax. Okay, so in other words, we know that all of the pay of all employees is going to be subject to Social Security. Okay. So the first thing we're going to do is calculate the Social Security taxes payable and Medicare taxes payable, and then prepare the journal entry. So to calculate these two taxes, we are going to be multiplying the dollar amount of gross wages and salaries and multiplying it by the tax rate. So 22,760 of office salaries, 65,840 of sales salaries. Total payroll is 88,600. Of that total payroll, the company is not going to pay 6.2% of it to the employees. They are going to pay it to the government. So we are going to multiply 88.6 times 6.2%. That amount comes out to 5,493.20. We multiply that same amount, 88.6 times 0.0145 or 1.45% to calculate the amount to withhold for Medicare, 128,470. So preparing the journal entry. The expense to the employer is going to be the total gross pay, what the employees earned. But the liability for all of that pay does not all go to the employee. The amounts that the employer owes to the federal government for Social Security and Medicare are recorded as FICA payable, Social Security and Medicare. All the amounts that the employer withheld from the employee's pay to pay to the federal government for federal income taxes is recorded as a liability. Amounts withheld for medical insurance is recorded as a liability to the insurance company. Union dues, those are the amounts that are due to the union. So the total expense, some of it is paid to the federal government, some of it will be paid to the insurance company, some of it will be paid to the union. Any amounts not paid to one of these other entities for the withholding, all of that will be the amount owed to and paid to the employee. So that would be the amount of salaries payable. So that is the journal entry for the employee payroll expenses and liabilities. Now let's do the second payroll entry to record the employer's payroll taxes. Remember, the employer is going to match whatever employees have withheld from their pay to pay Social Security and Medicare. The employer is going to pay that exact same amount out of their own funds. And in addition to that, they are going to be paying the state unemployment taxes, which every state is different, but for our example, we are going to use 5.4% of the first $7,000 that each employee makes in the state unemployment and 0.6% for federal. So remember, they told us that no employee has exceeded those amounts during this first pay period, so we don't have to worry about any employee exceeding that wage cap. So what we just simply need to do is calculate the unemployment taxes based off of total pay. Remember, total pay was 88.6. We're going to multiply that times 5.4% to get the state unemployment. And then we will do the same thing, multiply it by 0.006% to get the federal unemployment. So the employer, in addition to recording the expense incurred for the employees, they're also going to record another expense for their share of payroll taxes. They're going to record a liability to match the employees' FICA, Social Security, and Medicare. Then it's going to also record a liability for their unemployment taxes, state and federal. So they record additional expense over and above the salaries and wages of the employees. All right, I hope that helps with the Chapter 11 concepts.